Hello, friends. I am Debashish Ghoshal. I'm a practicing investment banker and a corporate finance professional. I run a boutique investment bank called Invictus Corporate Solutions LLP, and we focus on mid-market M&A, private equity, and structured finance deals. You can reach us at invictus.co.in or communicate with us at info@invictusadvisors.net. Friends, in everyday life, we often need to estimate the equity valuation of a business in which an investment is proposed. Someone could come to you with a cracker of an idea to invest, say, 10 lakh rupees in a company that, say, makes steel. At what valuation would you consider the investment? That is, what percentage stake in the said company should your investment of rupees 10 lakhs give you? Or you may come across a company that friends say is a rock star. This company is quoting at, say, 300 rupees per share, and we need to find out whether this price is too high, too low, or just right. Today in this short video, we will learn to answer these very basic questions using the DCF or the discounted cash flow methodology. I have tried to align this discussion on DCF valuation techniques as much as possible to actual real-life situations where we as professionals need to advise our clients on valuation and earn our living. So here we go on the focus of this session, discounted cash flow methodology. For ease of comprehension, we have divided this session into three parts. The first part of this session will deal with the question, what is DCF valuation? And what other methods of valuation are usually employed to arrive at the intrinsic worth of a business? And then we will do a brief comparative analysis of the various methods available. The second part of this session will deal with the calculation of free cash flow, the concept of free cash flow, and how it is utilized in DCF models. The third and final part of the session will revolve around mathematical principles behind the DCF methodology. That is, how do we derive the formulae and equations to make the method mathematically acceptable? So let's cross over and discuss the three main valuation methodologies that are widely used in financial circles. There are basically three approaches to valuation that are usually employed in financial circles. The first is the comparative company analysis, or the CCA method. In the CCA method, we estimate the valuation of a business by comparing it to similar businesses and benchmarking the subject business to other similar businesses in areas of financial position, operations, and various other relevant parameters. However, you may often come across businesses that are unique and don't have readily available benchmarks. For example, a business that specializes in drone technology. For this business, you will find it very hard to get a company that is similar. There needs to be similarity not only in the nature of business, but the scale of business as well. An established business earning 1,000 crores of quarterly profits is certainly not comparable to another business earning 10 crores of annual profits, even though they may be in the same line of business. So this similarity is something that is quite elusive in real life. The second issue that we need to deal with in the CCA methodology is the availability of information. Access to reliable information on the financial position and operational parameters of businesses we would like to compare the subject business to is quite restricted. The most reliable source of information in this respect are the stock exchanges. But what if the company you wish to compare your subject with is not listed? Sure, we have the MCA website from where we can download the basic financial info, but in many cases, these records are not updated, and getting reliable information on unlisted companies is often quite a nightmare. The second methodology that usually figure in financial circles is the comparable transaction method. The comparable transaction method requires us to check the valuation at which an investment has recently been made in another similar business and then apply the valuation multiples, for example, the EV/EBITDA multiple or the price earnings ratio, to the financials of the subject business. I have covered the calculation and application of these valuation multiples in a separate session. However, even for a comparable transaction analysis, we need the same set of inputs and same underlying information as in the case of a CCA. That is, reliable data and information on M&A parameters of similar companies, etc. If I were to try and value my edutech startup at the valuation at which Byju's has raised capital, I would certainly be extremely flawed, if not downright idiotic. In most cases, however, unless the M&A deals are done by listed companies, reliable transaction information is not available. And this brings us to the third and final technique that financial specialists use for valuation of companies. And this is the discounted cash flow methodology. Here, the idea is to understand how much cash will be generated by the business over its lifetime, and then arrive at the net present value of these cash flows by discounting them at an appropriate rate. Very simple, very objective, and very scientific. Does not rely on benchmarks, does not rely on external information. So let's go over and discuss the DCF methodology in a little bit more detail. The DCF methodology is a type of financial model that values a company by forecasting its cash flows and discounting them to arrive at a current present value. The DCF methodology is by far the most objective and scientific way to estimate the valuation of a business, since it involves a three-statement approach. That is, forecasting the P&L or the profit and loss account, the balance sheet, and the cash flows of the business for the next 5 to 7 years. In contrast with market-based valuation techniques like the CCA or the CTA, the idea behind the DCF model is that the value of a company is not a function of arbitrary demand and supply factors that govern the behavior of the shares of the company in the stock market. Instead, the value of a company is a function of a company's ability to generate cash flow in the future for its shareholders and other stakeholders. The first step in a DCF model is to prepare a three-statement financial framework for the business we want to evaluate. This involves various steps starting from an objective analysis of the business the company is engaged in. At this stage, we need to focus on factors like the products or services the company offers, the competition it has to contend with, the general trends in the market, overall environmental dynamics, and a host of other issues that determine the level of success a company can hope to achieve in a particular line of business. Based on the above analysis, we now need to arrive at an estimation of the revenue ramp-up schedule, cost parameters, working capital requirements, CapEx requirements, etc. Finally, based on available options to source capital, we need to close out the funding mix of the business. This leads us to the projected operating statement of the business, the projected balance sheet, and the projected cash flow statement for the next 5 to 7 years. In DCF terminology, this period of 5 to 7 years is known as the explicit period. Once our three-statement model is ready, we need to arrive at the discounting factor for use in our NPV calculations. The discounting factor is nothing but the cost of capital at today's date. We will discuss the calculation of the discounting factor in part 3 of this session when we deal with the mathematical aspects of the DCF methodology. Once we have our discounting factor, we can calculate the terminal value of the FCF, that is, value of all free cash flows that we expect to accrue to the business beyond the explicit period. Because remember, the company you are valuing is not going to shut down after the 5th or the 7th year from now. It will carry on as a going concern, so we need to have an idea of the present value of all future FCF beyond the explicit period as at the end of the explicit period. And then the last step is to arrive at the NPV of the entire FCF stream right from year 0 till the end of the explicit period, and then to add the terminal value or the present value of the terminal value at the end of the explicit period. If we add it all up, we get a number that gives us the valuation of the business. Now let's come to the concept of free cash flows. Discounted cash flow based methodologies are an estimation of the valuation of a business based on estimated future cash flows. Now, in order to arrive at a discounted value of future cash flows, what do we need first? We need an estimation of the cash flows that the business is going to earn going forward, or more precisely, an estimation of the free cash flows. What are free cash flows? Free cash flows, or FCF, are the cash a business generates after accounting for all expenses related to the running of the business and any other expenses required to increase or maintain its capital assets. Now, free cash flow can be classified for purposes of understanding the worth of a company into two broad categories. The first category is the free cash flow to firm, or FCFF. FCFF gives us the amount of free cash flow available to all providers of capital to the business, that is, both equity investors as well as lenders. The formula for FCFF is EBIT less tax on EBIT, add depreciation, less net increase in working capital, less net increase in capital assets. So this is the first kind of free cash flow that is utilized to develop DCF models. The second kind of free cash flow that we usually deploy for DCF models is the free cash flow to equity, which is a measure of how much cash is available to the equity shareholders of a company after all expenses, reinvestment, and debt are paid. And the formula for FCFE is profit after taxes, add depreciation, less net increase in working capital, less net increase in capital assets, add net increase in outside liabilities. Let's now quickly discuss the concept of free cash flow to firm, or FCFF. Any business operates by using its available capital. There are very broadly two types of capital that is available to the firm. The first is what we call owner's capital, which may also be termed as equity, and the second is borrowed capital or debt. This available capital is utilized to finance the operations of a company, and the operations then generate revenues. Once we take out all operating expenses from the revenues, excluding interest, we arrive at the earnings before interest and taxes. In order to factor in the impact of taxes, we multiply the EBIT figure by a factor of, within brackets, 1 minus tax rate. This gives us the post-tax EBIT. To this, we now need to add all non-cash charges, including depreciation and amortization. The next step is to account for the increase in the current assets of the company vis-a-vis the increase in its current liabilities. The increase in the net current assets is an integral part of the operations of the company because without working capital, no business can operate. Once we do this, we arrive at the business's cash flow from operations. There's a little bit more to be accounted for after this, and this is the capital expenditure or investment in fixed assets and other business investments required to keep the business running. And this, my friends, gives us the measure of the free cash flow to all capital providers, or FCFF. Another way of measuring how much cash is being generated by a business is to look at the amount of cash available to the owners of the business after all operating, investing, and financial obligations are fulfilled. This is what we call the free cash flow to equity, or FCFE. The equity of a firm is utilized along with the debt availed to generate revenues. To arrive at the FCFE, we must first consider the net income or post-tax profits or profit after taxes of the company. To this, we add the non-cash charges, including depreciation, amortization, and the like, and then deduct the net increase in working capital, investing obligations like capex and business investments, and the net repayment of debt during the financial year. The net repayment of debt is essentially the amount of debt repaid during the year less the amount of debt availed during the year. At the end of this exercise, the figure that we are left with is the free cash flow to equity, or FCFE, generated during the financial year, and this represents the amount of cash available to the owners of the business after all operating, investing, and financing obligations have been met. Now let's look at how FCFF and FCFE are related to each other and how they're different. FCFF is an unlevered metric. That is, it treats both equity and debt capital equally, and it is gearing neutral. That is, it is not impacted by the mix of debt and equity capital in the capital structure. FCFE, on the other hand, is a levered metric and only looks at cash flows after taking care of all operating, investing, as well as financing obligations, including debt obligations. So by now you might have guessed that if there is no debt in the company, FCFF and FCFE in any particular year for a business will be equal. When we discount the annual FCFF generation over the explicit period, we arrive at the enterprise value of the business, that is, the total value of all the capital employed in the business. A similar exercise using FCFE will give us the equity value of the business, that is, the value of the ownership of the business. This brings us to the key mathematical parameters underlying any DCF-based valuation methodology. The first key metric we should examine here is the discounting factor. The discounting factor in the case of an FCFF-based DCF model will be the weighted average cost of capital. In order to arrive at the WACC, or weighted average cost of capital, we need to first estimate the cost of equity. And in order to calculate the cost of equity, we usually deploy what is known as the capital asset pricing model, which says that the cost of equity, or COE, will be the risk-free return, or RF, plus beta times the difference between the market rate of return, or RM, and the risk-free return. While we can use sovereign treasury rates as a proxy for RF, there are various opinions on which benchmark RM can be mapped to. One simple way of approximating the RM would be to calculate the return on a common stock exchange index, for example, the BSE Sensex, over a long period of time, say around 10 to 12 years. This would give us an idea of the return the market has generated on a steady state basis. Beta is a measure of relative volatility of the stock under question, and this is relative to the overall market. A beta greater than 1 suggests that the stock is more volatile than the broader market. That is, if the broader market or the overall Sensex were to go up by 1%, this stock would go up by more than 1%. And a beta less than 1 indicates a stock with lower volatility. For an unlisted company, we generally assume a beta that is reflective of the degree of fluctuations that are seen in similar listed companies. However, if information on a similar stock is not available, we need to use our discretion about the potential volatility of the stock, given the nature of its business, the industry it is in, and so forth. The second leg of the discounting factor is the cost of debt. The cost of debt is the post-tax cost of capital borrowed, which is essentially interest rate times, within brackets, 1 minus tax rate. Hence, our discounting factor, or WACC, is equal to COD, or cost of debt, times D, where D is the debt equity ratio, plus COE, where COE is cost of equity, all over, within brackets, 1 plus D, where D represents debt equity ratio. Please remember that in case of FCFF based models, we use WACC as the discounting factor, but for FCFE models, we simply use the cost of equity as the discounting factor. At this point, we should examine two other metrics that are critical to a DCF valuation model. The first is the terminal growth rate. The terminal growth rate is the rate at which we assume the business will grow on a sustainable basis after the explicit period. We usually consider a terminal growth rate of between 1 and 2%. And the second metric is the terminal value of the free cash flow. Terminal value is the present value of all future cash flows starting from the year next to the end of the explicit period, as at the end of the explicit period. Hence, if the explicit period is for n years, terminal value or TV is equal to, within brackets, FCF n times 1 plus G, where G is the terminal growth rate, all over K minus G, where K is the discounting factor and G is the terminal growth rate. As we saw, the terminal value is the present value as at the end of the explicit period of all future cash flows beyond the explicit period. We essentially work with the assumption that the company we are valuing will remain a going concern till perpetuity, or effectively till such time as the discounting factor will be too high to have any impact on the overall calculations. So the terminal value is the sum of the PVs of all FCFs going forward from the end of the explicit period. Once we sequence all of it in a single equation, we have a simple geometric series, which is this. Applying the formula for the sum of a geometric series, we find that the entire series is equal to 1 plus k by k minus g. And so the terminal value works out to FCF n times 1 plus g by k minus g.